Hi, this is Matthew Cratter from Trader University, and today I want to talk about how to buy put options on a stock. It's a question I've been getting a lot from you guys, so I thought I'd make a video about it. If you're worried about this bear market, want to learn how to trade options, or just are interested in seeing what I'm trading these days, be sure to hit that subscribe button. So let's start with some really brief terminology. A put option is just an option, which is a derivatives contract. A put option is something that you buy when you think that a stock is going to go down. And there are also put options. You can buy put options on crude oil or Bitcoin or any other underlying security or asset. Now, a put option gives you the right to sell 100 shares of stock. So that's sort of the contract size of one put option. It's usually 100 shares. It gives you a right to sell 100 shares of stock, in other words, to put it away onto someone else at a specific price, which we call the strike price. We'll talk a little bit more about that, within a fixed period of time. That is right before the option expires. So again, you want to buy a put if you think a stock is going to go down. So a question I got from a reader or listener was, I want to buy puts on Carnival Cruise because I think their stock is going to go way down. So let's use this as an example. If you want to find options, pricing, and contracts, just go to Google, type in Yahoo Finance, and then type in the name of the company that you're interested in. It will automatically figure out the ticker, which for Carnival Cruise is CCL. So you click on this link, it will take you to the main page for that particular stock ticker. And then you want to click right here where it says options, and that'll take you to this page. Now, when I'm buying puts or calls, and again, options it's a very complicated field. There's a lot to go into, so I'm going to be vastly simplifying for this the purposes of this video. But in general, if I wanted to buy puts on Carnival Cruise, and again, none of this is investment advice. I'm not actually buying puts on Carnival Cruise. I usually go about 2 months out. So right now it is April 4th, 2020. And you can see right here, this is the drop down of the different expirations. And it's sort of more of an art than a science, deciding which expiration to pick. Generally, if you go, the most options decay happens in the last 30 days before expiration. So if you're going to pick a really close expiration, like April 9th, 17th, 24th, you have to be expecting a really big move really quickly. In general, I like to give myself a little more breathing room, so I'll go anywhere from 45 to 60 days out. In this case, I'm going a little bit more than 60 days simply because of how the expirations work. So I'm going to hit June 19th, and then you'll see that calls are listed at the top here. We're going to scroll down to the put section. These are puts on Carnival Cruise that expire on June 19th. Now, let's look at a quick chart of Carnival Cruise. You can see that it's gone way down. But I think this chart's a useful way of thinking about options. So there are three kinds of options. You can buy an option at the money, out of the money, or in the money. Currently, the stock, Carnival Cruise, CCL, is trading at $8.49. And when I'm buying puts on a stock, I usually like to buy them either at the money, which means at a strike price that's equal to where the stock is trading. So in this case, I'd buy the $8.50 put options. The $8.50 put options do not exist as a strike. We can see here that for June, we just have 10, 7.50, 5, and 2.50. So what I will do is, if I'm buying puts on a stock going 45, 60 something days out, I will try to buy them right where the stock is trading. So in this case, right around $8. But then we look and we see, well, there's no $8 strike. So then what I will do is I'll go the next strike down. And this is called an out of the money put, because the strike price is below where the strike price is below where the stock is currently trading. So if the stock is trading right here, the strike price is below it. This would be an out of the money put option. And if you want just a quick snapshot of the different meanings of in the money, of moneyness, basically, in the money, and in the money put, the stock price is below the strike price. I'm sorry. In the money put, the stock price is below the strike price. At the money put, as we said, the stock price is right at the strike price of the put. And then out of the money put, the stock price is above the strike price. So you can just pause that if you want and write that stuff down. It's not as necessary here because I'm going to give you sort of a visual demonstration. So a put option is a bet that Carnival Cruise is going to go down. We're going to buy an at the money try to buy an at the money or out of the money option. So in this case, we'd be buying the 750 right here. And now you can see the pricing. This has all the pricing. It's currently Saturday, so the market's closed, but it's currently bid, or at least when the market closed yesterday on Friday. People were willing to buy this option at $1.80. They're willing to sell the option at $1.95, and the last price, or the settlement price, happened somewhere between that, so about $1.85. And so if you're buying a put, you will always be able to get filled at the asking price. This is where people are offering you the put. So you could just buy the put right here at $1.95, or you could try to, what I usually try to do is I try to put my order somewhere in the middle of this bid-ask spread. So maybe I would put it at 187, 190, somewhere right in the middle between the bid and the ask. And you can see that's indeed where the last price occurred. Now, options contracts have a multiplier associated with them. As we said, each put option allows you to control 100 shares. And so if I'm buying the 750 put options, what I'm really buying is the right to sell someone 100 shares of Carnival Cruise stock at $7.50. Now, right now, the stock is trading at $8 and something. And so this is not something that I would need to use right now, simply because I could go in the open market and sell my shares for $8.50 or wherever we said it was trading, $8.49. But what put options are is they're a form of insurance. And so what they insure you against, what they allow to happen, is if the stock falls a lot, let's say the stock falls to 5, this put option will still allow me to sell someone the stock at $7.50. So everyone else will only be able to sell the stock at $5 a share, which is where it will be trading, theoretically, and I'll be able to sell it at $7.50. That's basically how put options work. Now let's look at the same thing on using Robinhood. So if you just go in, if you have an account with Robinhood, and again, I use them, but I'm not affiliated with them. People have asked if I have any. I don't have any commercial sponsors. I just show you the tools that I'm using. You go into Robinhood, robinhood.com, and this is a nice broker because they don't charge any commissions. So you type in CCL right in the search box here, or type in Carnival. It'll take you to this page, and then you're going to want to click right here where it says Trade CCL Options. When you first open up an account with them, you're going to have to get special permission to trade options, but it's not too hard to get upgraded to that. You just have to demonstrate some knowledge, I believe. So if we click on this button here, it'll take us to the option page. There's again a drop down here, so we can pick the expiration. I'm going to pick the June 19th put options again. And I like their visual representation here because it basically shows you where the stock is trading. I don't know why it has it here at 8:38 when it closed at 8:49, but it doesn't really matter. In real time, this will all be updating correctly. And so another way to visualize buying an at the money or out of the money put is that it's going to be anywhere below this line. So you can see they have a line here that represents where the stock price is currently trading. So an at the money put would be right here at the share price. An out of the money put would be any of these different strike prices. And you can see the strike prices are listed here on the left. And out of the money put would be any of the strike prices that are below this line. So the $7.50 puts, the $5 puts, and then below here the $2.50 puts. So we're going to click the buy button here because we're buying a put. We could also be buying a call. We could be selling a put. We could be selling a call. But in this case, we're going to be buying a put that expires June 19th. And we're going to be looking at the $7.50 puts simply because that's the strike price that's immediately below where the stock price is currently trading. And then if we just click the little plus sign over here, it turns into a check and it loads your order over here. So long put is another way of saying I'll be buying a put expiring June 19th, strike price $7.50, and the price of the put will be $1.88. I think they're adding a small SEC fee. I don't know why this is $1.90, but it's basically the same thing. We'll just use $1.90 for the purposes of this. Now, how do we calculate? And then basically, if you want to buy this, you just click continue, and you can actually buy it. Again, not investment advice. You really got to study options before you trade them, or trade them in very, very small size. Now the total cost will be $1.90, $1.90, but because there's a multiplier associated with this, they will actually, in my account, this will require having $190 in there. Just take $1.90, $1.90 times 100. And so in order to buy one put at this strike price, at this expiration, you'll need $190. Now, what would be the break-even point for this trade where we don't make any money, but we also don't lose any money? Well, the way you calculate a break-even point on a put option trade is you take the strike price, in this case it's $7.50, and then you subtract, assuming it's an out of the money or at the money put option, you subtract the price that you paid for the put call, the put option. So in this case, the strike price $7.50 minus the price I paid, $1.90, gets me $5.60. And so this $5.60 here, $5.60, is the break-even price where I won't lose any money or make any money on the trade at expiration, or as we get very close to expiration. So in order to just break even, Carnival, which is currently trading, call it at $8.50 or $8.38, wherever it is, Carnival's going to need to fall from $8.50 to $5.60. Now that's already a very big move. That's $2.90 divided by, call it $8.50. So the stock has to basically fall 34% before I start making money. And that's a pretty big move, even for a penny stock like this, to fall 34%. And so this is something I always like to remind new traders, is that you can have your thesis about what's going to happen in the world, and you can be right or wrong about that. In this case, the thesis or hypothesis is that Carnival is going to fall, that the stock is going to go down. But then you always have to look at and figure out what is priced in to the market. So in this case, these options are very expensive. They're very expensive, and the options are very expensive, which means that the stock has to move more than the option is pricing in. So in this case, the stock has to fall more than $1.90 for you to start making money. So the stock is already pricing in high volatility, we would say. We call it high implied volatility. And one reason that the implied volatility of Carnival is so high and the put options and call options are so expensive is because there's a lot of uncertainty surrounding the stock. They've had to furlough a lot of people, lay people off. No one wants to get on a cruise when there's the virus going around. And so their business is basically ground to a halt. They've had to issue shares of stock and sell more debt to just stay in business. So there's a lot of uncertainty surrounding the survival, really, of this company in its current form. And there's obviously the risk of bankruptcy that's being priced in, which is fine. I mean, this is what our bet is. When we buy put options on Carnival, we're betting the stock is going to go down. If the company files for bankruptcy, most likely the stock goes to close to zero. So let's talk about what happens if the stock goes to zero, or as I'll say to make it less complicated, what happens if the stock is close to zero, close to expiration. So it goes very close to zero, or to zero by June 19th. They're very close to June 19th. Well, we bought a $7.50 strike. That's the strike price of the put. If the stock goes to zero, this put option is going to be completely in the money. It's going to have all intrinsic value. And so the way to calculate what a put option will be worth is you just take the strike price minus the stock price if the stock price is below the strike price. And so if the stock goes to zero, very close to expiration, these put options will be worth $7.50. Now, it's possible, I suppose, for these options to be worth a little bit more than that if they have some time value left, if the stock falls very close to zero before expiration. That's sort of a debatable thing, but let's just say the stock basically goes to zero, close to expiration. So each of these put options, and remember, we paid $1.90 for them. Each one of them is going to be worth $7.50. Basically 7.5, the strike price minus the stock price at zero, $7.50. So we paid $1.90 for it. We can now sell that put option. We can go back into Robinhood and sell it. We don't actually have to own the stock to put it away on someone. We can just trade the option, which is nice. Now you can also use put options as a form of insurance. So if you own Carnival Cruise stock and you want to insure yourself, you could buy, and you own 100 shares of stock, you could, for example, buy one put option. But I'm showing you an example. This is kind of a speculative example where we are just trading the put options and we don't own the stock. And you don't need to own the stock in order to have the right to put it away on someone. Basically, you just trade out of the option before expiration. So we paid $1.90 for one put option, one contract. It's now trading at $7.50, let's say. So our profit is just $7.50, the price we can sell it at, minus the price we paid for it, $1.90, gives us $5.60. Now the multiplier again is always 100, and so if you make 5.6 points on a put option and you own one contract, your profit is just going to be 5.6 times 100 shares, multiplier, times 1. So you will make $560 per option contract if Carnival goes to zero. So this is a fairly, if you just look at it from the perspective of a risk-reward trade, it's not a bad, this is obviously a way to make a lot of money. You start off with $1.90 and then you end up making $560 in profits on top of that. So you really end up with, call it $750 at the end. Now, that's a good risk reward, but it's also, one way to think about this is that these options are very expensive. And so if you're correct and the stock falls, let's say the stock just falls to, let's say the stock goes from $8.50 where it is now, and it just falls to, call it $6, you're still going to lose money because the stock has to get down to $5.60 in order for you to make money close to expiration. Now I'm simplifying things because if demand for these put options goes up a lot after you buy them, you can also make money without the stock moving. When there's a lot of demand for put options, their price goes up and you can sell them at a higher price. Another way of saying this is higher price put options have higher implied volatility, and so they trade at higher prices. So the two ways to win on this is the stock falls more than $1.90, more than you paid, or demand for these same put options with the same expiration and same strike price goes way up. And it's a little bit like buying gold before a crisis. Then you get a crisis, and all of a sudden, even though you still have the same amount of gold, the demand for it has gone up so much that you can sell it for a higher price. Now, why are Carnival put options so expensive? Well, we said, of course, that there's the bankruptcy risk, but there's also put options in a bear market. Right now, we're in early April 2020. Put options in a bear market become very expensive. And one way of seeing this is just looking at the VIX. The VIX is a measurement of the implied volatility, or how expensive or inexpensive at the money options on the S&P 500 are. And so when all stocks become volatile, their implied volatility goes up as well. We're in a very uncertain point right now. Stocks could go up a lot, they could go down a lot. And so insurance becomes very expensive. It's like buying flood insurance. Basically buying put options now is like buying flood insurance when your basement has already begun to fill with water. If you can get anyone to sell you insurance in a situation like that, the insurance is going to be very expensive because basically the crisis is already there. And this is what makes trading options difficult. And so you can be right, as we said, you can be right that Carnival Cruise is going to fall, that its stock is going to fall, but you can still end up losing money simply because the put options are priced so high. Now, there are a few ways around this. One is that you try to buy these put options before the crisis happens, or you just have to be more correct than the market is. In this case, the stock has to fall by more than $1.90 for you to be able to make profits. So again, that's sort of the disconnect between you can be correct that the stock's going to fall, but will you make money on put options? And I've given you a way to calculate that. In this case, the stock has to fall to 560 for you to break even. If the stock's above 560, you will lose money on the trade. If the stock is below 560, you'll start to make money on the trade. And then your max profits will occur as the stock approaches zero. Another way to see that these put options are expensive is just to look at the short interest on the stock itself. Now, short interest just is a measurement of how many people are shorting the stock or betting that the stock itself is going to go down. And so if we go back to that same Yahoo page and we click on statistics and scroll down, you can get the short interest information. And so right here, I like to look at short as a percentage of float. Anything over 10% is a fairly highly shorted stock. It's currently, Carnival is currently at 14.51. And so even 14.51%, which means that almost 15% of all the tradable shares are sold short. So this is a name that a lot of people are betting is going to go down. And so it becomes expensive to short sell the stock. You have to borrow the stock in order to short sell it. And so one way around that, which is not really a way around it, is you can buy the put options, but the put options are expensive as well because markets are fairly efficient. And if someone wants to short the stock and they find that shorting it's too difficult, they'll drive up the price of the put options, and vice versa. If someone says, wow, these put options are too expensive, I'm just going to go short the stock instead, well, the price to short as measured by the short percentage of float is very high as well. Now, this can get up to 50% or even 100%. But this is still a significant short interest as a percentage of a float. Now, if you enjoyed this lecture and you want to learn more about how options really work, and you have if you have some time at home and you want to spend the time in self-education, which is always a great use of time, check out my course. It's a paid course. You can watch the whole thing online. It's called Learn to Trade Options Like a Pro. And there's just a tremendous number of lectures here. You can, by the time you complete this course, you're going to know more about options than certainly anyone that you know. So this is a good one if you enjoy this idea of trading options. If you want to know what it's like to do cash secured puts, or to do put spreads or bearish call spreads and different ways to trade in a market environment like this, this is a great course to check out, as well as my bear market trading strategies course. Now, the good news is you don't have to pick which course you're interested in. You can join Trader University Premium, and you can get access to all of these courses for a single price. So you'll get access to swing trading with options, price action trading. You can follow my crypto investments, learn to trade futures, financial statement analysis, and of course my flagship course, Learn to Trade Stocks Like a Pro. If this is something that interests you and you'd like to get unlimited access to all these courses for 30 days, you can just scroll down here and click Get It Now. Now, 30 days worth of access, 30 days tuition is normally just $125, but I want to make a special deal for you guys because these are rough financial times, and so I have a coupon code. If you just go to that, basically click Get It Now, it'll take you to this page, and right here where it says Have a Coupon Code, you can just type in YT99, and then click the Update button, and that'll take the price down from $125 for 30 days access to just $99 for 30 days access. That'll give you access to all those courses, all 12 or 13 courses. You can watch all of them in the first 30 days and cancel. You won't be charged again. There are no long-term contracts or anything like that. And if you are interested in a topic that has to do with the markets, whether it's options or futures or crypto or stocks, and you don't see it available, you can just request it as a subscriber, and I'll create a whole new course for you or a whole new lecture for you, and then of course share it with everyone. And that's how we can really grow this into a real resource that new traders and new investors can use, and also more advanced traders and investors. This course on trading options really goes into a lot of depth. We talk about butterflies and just anything you can imagine, straddles and strangles and how to adjust them, iron condors, etc. So check that out if that's something that interests you. If you want to spend some time really learning how the markets really work, now's a great time to do it, especially if you have some quiet time and some downtime. Thanks a lot for listening. Hit that subscribe button if you haven't hit it already. Hit that like button, and let me know questions or comments in the comment section below. If all this went over your head, don't be discouraged. Options are tricky. It took me a couple years to figure them out. Once you figure them out, they're much simpler than driving a car, flying an airplane, or anything like that. But just give yourself time and be patient with yourself. Thanks a lot for listening, and I'll see you in the next video.